All right, good afternoon, everybody. Today is December 8th, 2023. The year is almost over. Time flies. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Disclaimer is always the same, not licensed. Can't tell you what to buy, sell, hold, how much to own, how much to, where to sell, where to stop yourself out. We try to stay in our circle of competence, which is really research, education, etc. Okay, thank you. It's been maybe a couple of weeks since I did one, so I have quite a few slides. Some of them have quickly gotten dated a bit, maybe because of the markets action is so strong so quickly. Everything changes so much faster nowadays. But we'll go through market thoughts, stocks to watch, industry groups, quote of the week. Same drill as always. So I took this from Twitter, Bloomberg, Goldman Sachs, Investment Research. It's a little blurry. I apologize. Hopefully you can see it okay. But the gist of it is the fact that stocks are much more volatile on earnings nowadays than they once were. And I think we're all aware of that, but this is just showing you the math on the average earning day move um, from stocks. And so you're getting a lot of gaps. Gaps are hard, more difficult. Gaps up, gaps down. They gap up, they come back. They gap down, they come back. They gap up, they run. They gap down, they keep going down. They do all of it. And I just don't see any edge in how the stock closed the day or the week before like you might have had previously. I feel like maybe 20 years ago, 15 years ago, analysts were less surprised because they're getting a lot more hand holding from the companies, which is a lot harder nowadays because I guess, it's illegal. So that makes it difficult to gauge. So it's just the game, unfortunately, and you have to build it into your model. Whether you never own. I know some people don't like to own a stock into earnings at all, or they want to be up 10%. They have some kind of rule. I want to be up X amount into earnings. Uh, that's one rule I've heard. I've never heard Bill O'Neill, the founder of Investors Business Daily, say anything. I never heard him once say, "This is my rule for earnings." Uh, I wish he had written how to make money in stocks one more time. Another revised edition, I think a chapter on earnings, handling them would have been great. But I don't know if he what he would have said about that. I tend to hold through earnings, good, bad, and indifferent. I will, adjust my position size accordingly if I think there's could be potential volatility. And if I hold five stocks through earnings in a earnings cycle, I'm hoping that two are up, two are down, and one is sideways, and the two that are up 15%, and the two that are down 7, 8%, and so therefore, from a magnitude standpoint, I've more than survived that earnings cycle. It doesn't always occur that way, but I used to try to cherry pick them. This one's going to be up, this one's going to be down, and I just the market knows. So I think you probably need to just either all hold them all always through earnings or never through earnings. Uh, if you're going to have a big winner, you've got to hold through earnings. You're never going to have an Nvidia or a Google or a Microsoft or Tesla, and you're going to get out and get back in after earnings, get out and get back in after earnings. You're going to get left in the dust on one of those earnings reports. It's sentiment is one of my favorite things to follow is sentiment. It changes so fast. Remember, price creates sentiment, not the other way around. People don't get bearish, start selling, and that takes the market lower. They get bearish because the prices are going down. And the more they go down, the more bearish they get, and vice versa. So the bearishness has just collapsed in the last few days. I'm sorry, in the last few weeks, and rightfully so, because the market just is just powered higher and higher. It's got a bunch of gaps on the Nasdaq on the chart, and we'll get to that. And so you've had just a huge collapse in bearishness. Now, it doesn't mean you want to go the other way. if this was the opposite, like if this was a huge collapse in bullishness, then I would say you might want to dip your toe in the water, start getting long, or look to get long, or be ready to get long. It just doesn't work as well this way. Here's another chart, same thing from the daily shot. You can see it's as low as 2021. This is a great chart too. So it shows an overlay of the S&P. Gosh, I apologize. I forgot to give credit. I believe this was Brent Donnelly, his tweet. Forgot to paste his Twitter handle in here. But there, this is the S&P and the blue, obviously, and then the spikes are the bears. So you can see the spike in the late 2022 period, and that's where the market bottomed. You can see the spike in early 22, market bottom for a little bit, and then the spike in November, just a single spike, but that was good enough to create this huge rally that we've had. So this is what you look for the other way. It works, I would say, particularly well the other way. Bearishness, you can go long, but it doesn't work as well, if at all. Bullishness, go short or get out. I've seen it stay pretty bullish for a long, long time. And that's just the natural ebb and flow of the market. The market's naturally going higher, whether that's GDP or earnings or inflation or all of the above. It doesn't matter. History, the markets had a natural ebb higher over longer periods, and so that probably plays into this as well. So here are the returns year to date, scatter plotted. Very interesting. Software, meme, YOLO stocks, AI, mega cap tech. On that left-hand side, housing done pretty well. And then on the right-hand side, defense, rate sensitive financials, commodity sensitive, etc. So, and I think this probably would have been just exactly the opposite of of the year before. So, um, I apologize. I got distracted by the 2023 returns are on the left and the 2022 returns across the bottom. But the bottom line is it's been a total switch in what's been good this year versus previous. Pardon me. And so you have to be on guard. You have to be prepared you have to be flexible. You have to go with what's working. You have to be prepared to change. It's very dynamic nowadays, for sure. There's a lot of talk of recession, and I don't know what to make of it. I know that I've never made a dollar trading the macro part, so I wouldn't spend a whole lot of energy on it. But if we do go into a recession, it's likely to highly likely. It's not a certainty, but it's highly likely that the indexes go down based on history. And this is a chart of trucking employees, and it's got a pretty good track record going back to 1990. And so if it continues to roll over, it could be that we go into a recession. I know before 2023 started, pretty much all the economists, not everyone, but the majority, the high majority, thought that we would be in a recession in 2023 because of the yield curve. And so far, that hasn't happened. So maybe that catches them off guard, and we'll see. I'm sure they'll all have come out with their votes later on this month for what's their recession call for 2024. And if they all say it isn't happening, then I'll be wary of it, because I don't know why. Again, smart people, smart girls, smart guys, but they just never seem to get it right. It's too hard to predict. It's not their fault. I can't get it right either. I can't predict it. It's just too hard. So you're better off just going with what's happening at the moment. So just trade the market you have. I wouldn't worry so much about recession. If it comes, what's going to happen? The market will roll over. The stocks you're in will roll over. You'll get stopped out. Nothing will set up. There won't be any new buys, and the market will pull you out. Um, in Nicholas Darvis's book is a great chapter on this happened to him. He just got kind of stopped on a bunch of stocks, and none of his other stocks he was looking to buy got triggered, and he didn't know any better, and he was out for a bear market. And I don't remember what year it was, but he just sat out a bear market just with those simple type of rules. So you don't have to make it so hard and stuff. You don't have to predict what the trucking sector is going to look like, but it's fun to listen and look and just kind of put the mosaic all together. All right, let's look at the indexes. So here's a chart of the Nasdaq, and you don't have to be bullish, but I just don't know how you can be bearish with a chart like this. So I would say, with a chart like this, you're neutral to bullish, you're flat to long. I just haven't seen any reason to be short in the last handful of weeks. There's, you could try it, but with very little regard for profits, it would seem. And so I've tried it a little bit here and there, and it hasn't been very fruitful. And this is why the market's so strong. So this is a really, really strong tape. Is extended? Is it this? Is it that? Yeah, it's always that. It feels like it's always hard to get in. You have to be aggressive early on. You can't hesitate. That's why we have the rule to buy something on the follow through day, even though it might not work, because we want you to start putting money to work. If you're not in, you got to start putting money to work so you can get some stuff here. So it's a little easier to buy here if you have to. It's very difficult to buy there if you don't have anything down here. I know that from experience. So it's a very strong market. Um, 1, 2, 3, 4, 5. What's that? 6 weeks up in a row, and we're above this high. And I might have misspoken on a previous um, webinar where I talked about maybe an all-time high. We're not there at an all-time high. We're what's that about 8 to 12% away or something like that. So we're close, and I actually, I've said it before. I thought that the market would make a high. I don't remember if I said all-time high or 52-week high, but we're going to make a 52-week high for sure. I'm just convinced of that and have been. I think the Qs did already. Yeah, the Qs did already, and the SPY did. If not that day, then barely that day, but definitely today. So we're there. We're 52-week highs, but so let's just get through here. It's good. It'd be great if we pushed all the way to new highs, especially like early next year. My experience about looking at markets, if you go back and study, I would go back and study all the previous markets. So like you have a long window where you didn't make a new high in the indexes. And so the last new high was November of 2021. So we're over 2 years. So let's say it makes a new high in March of next year. Be like 2.5 years since it made a new high. And if you go to like a monthly chart, you'll see when you get these kind of long, long periods, and this is a very unusual one, but like these really long periods, what happens? So I was looking at the S&P. You could look at the Dow. You could look at the Nasdaq. The Nasdaq's probably not as good an indicator because it doesn't go back as far, and it's just so much more dynamic an index. But so let's backdate the S&P to let's just go back to 1999 and so like here you get what's that, November 1980 and October 1982. And I apologize, I've been a little bit under the weather, so I'm gonna try to fight through this. I'm so sorry. Anyways, so you have a 2 year window there, and then the market makes an all-time high. And it was very bullish. Like it ran up. That's pretty good. And then went sideways and then made another leg, and it went on for a long time. It was a 5 year until the 87 crash. That's what that is. So you had a really good runway from that new high. And then after the 87 crash, you see the market made a new high, new high. It was a bit of a head fake. But the nice thing is it doesn't make a lot of progress. So like it wasn't like it went up here and then did that. That would make it tough. So you get into new high and it just has a hard time going anywhere, right? It looks like it sputters, tries to go up again, sputters, and then you had the 1990 bear market, which was short, but it was enough. I think that's a 20% bear market. And then the market made another high, and boom, a great environment to invest in. This was a mini bear market, 94, 95. I remember this, but then 95 was gangbusters. So it was a really great period. So I looked and looked and looked. If you do the Dow, so and our charts don't go back as far as they used to, unfortunately, at this very moment. But this was like a new high for a month or two, no progress, bear market. A new high. Does that make a new high? Not quite, not quite, but it jumps up there, no progress, right? Bear market. New high, 1030.97 is higher than 1014. The 1014 high was in 76. The 1030 high was in 81. So 4 or 5 years, a base breaking out to new high. I'd probably think bullish. No progress. Pokes its head up there. It can't go anywhere. Bear market. Finally, 81 to 82. This is that one we talked about in the S&P. New high, progress. Pretty good. You could make money there, especially in individual stocks. A little bit of a setback, but then amazing progress. So the moral of the story is, doesn't mean it has to play out this way, but if it pokes its head into new high, I think you have a great asymmetric trade. You have the chance that we have a lot of runway. Maybe there's a bunch of runway like this, or does it make a bloody fortune over a number of years? Or it's a head fake. And you know how you know it's a head fake? Is it won't make any progress. So it'll go into new high. They'll stay there for a month or 8 weeks or something, mess around, and then it comes back down. And then you're probably going to have a bear market. And you get another bear market, and then the next time it'll work. So I'm actually pretty excited about that. If we can get to, let's go to the S&P. So I really am hopeful that we break this in this little rally we're in. That doesn't mean it has to break it tomorrow or next week, but sometime, next couple of months. And then that's exactly how I'll trade it. I'll trade it with the idea that I'm going to risk a little to make a lot. If it's a big bull market, I want to be in there. But if it goes to 48, let's go to the weekly. So let's say it runs from 48.18 to 48.90 and then comes back down to 48.18. I'm going to be very cautious. Anything below 48.18 would just get me more and more cautious / bearish. So that would give me like a really good line in the sand where I can be heavy, be long, get long all the best names, and see if we can get some type of rally. So I don't know, maybe we could use even this, what we're doing right here, as possibility. So if it goes above 4607, which we're very close to doing. No, we did do that. What did we close? Oh, we closed at 4604, but we hit 4609 today. Look, you're not trying to micromanage it to pennies on the S&P and give it a little bit of room to breathe. So I'd like to see, a little bit more progress. And then I think you could use this as your line in the sand for, your exposure level, so to speak. Now, food for thought, but that's just kind of how I've been thinking about the indexes lately. But the bottom line is, here's the S&P. I know it's heavy in the, NASDAQ. The FANG is acting really well again. We'll review those as well. It is what it is, but there's other stuff to buy, and we'll look at some of those stocks. So I think as you sit here now, you should be bullish to neutral. If you don't want to be fully invested, that's fine. I don't have a problem with that. Sometimes the market beats me, and sometimes I beat the market. You it's very difficult to put a bunch of pressure on yourself to always, be beating the market. I wouldn't play it like that. I've said that before. All right, so let's go to the industry groups. It's energy solar is the worst. Remember, I mean, it wasn't that long ago. Energy solar was the very best group. This is just perfect example of how it changes. Have you seen some of the energy solar stocks? They've just gotten torched. So coal is still number one. AMR looks very good. CEIX had a weird day. I only own AMR. There's others, but coal is the number one group. Food, dairy products. I just don't know what you do with that. There's two stocks. Commercial services, education. So some of like the like EDU, Chinese education, computer software, financial, computer software, database, apparel, shoes, Deckers is acting really well. Education, media, security, CrowdStrike. Gosh, I got wiggled out of that. It's one of the downsides to how I trade it. I took profits and didn't get back in. That's been an amazing stock. And there's been others that have acted well. Shoe, household furniture, oil and gas, transportation pipeline. It's probably it's it's currently 11. It was 11. I don't know. I feel like it's losing a little bit of its luster, but that's a group that I like. I think there's some good names, but they haven't really participated in the last couple of weeks. Long-term care, software desktop. So I don't know. I don't know what to make of the groups. Um, I'm a little surprised by the groups, to be honest with you. I thought it'd be a little bit more heavy in like software. Like I'd just see software, software, software. And they're right here: computer software, enterprise, data storage. There's some of that, but I guess I thought it would be a little bit more top heavy in that group. But that's the industry groups. There's that. Uh, what I guess we could look at some international stocks. So, like I heard that the DAX made a new high. Now, this is a German ETF, EWG. We don't have the DAX in Market Smith, but I don't know. It looks okay. Um, and emerging markets just look okay, which has been the drill all over and over and over. How about the Russell? Russell is trying. I'm not a big fan of the Russell. I've never really traded the Russell that I can recall ever. It doesn't really go anywhere, it seems. You can see the relative strength is so poor and it's so far from new highs compared to the other indexes. But at least it's not acting that terrible, which would be a problem. So it's kind of a stock picker's market, I guess, is the way to put it, which is fine because that's what we are mostly trying to find alpha in individual names. So let's jump to the names. So let's start with the big boys, NVIDIA. So I really think this is kind of the line in the sand, 476 give or take, and anything below it, like I thought it actually would go lower, and it didn't. It held the 50-day pretty good, and you can see on the weekly, it just looks pretty textbook. This actually looks like a cup with kind of a high handle. So if we go to the daily, you've got kind of a 505 high handle, or you might draw some kind of trend line like that. I do own NVIDIA. It's just a disclosure. So you this could be like an entry if you don't own it. It it's gotten a little bit more difficult to trade, but I like to buy it on pullbacks versus breaking out. I just think it's a little bit, it's not easy, but the risk reward, the asymmetry of the trade is better, I think. I think if I get it right, I have a lot more room. So you had a lot of talk like on Twitter about this head and shoulders top right here. When it broke that neckline, that was the short. How'd that work out? It worked out great if you were willing to go opposite, went up 100 points. Now, I think I made 25 of the 100, but that's my fault, not the market's fault. So I think the setup here is pretty strong for Nvidia. You've got kind of a line in the sand. You don't even have to risk 7%. Well, you probably risk half of that. If it came back down below that, you'd probably want to be out, at least temporarily. And it could get choppy. It could start doing that. Just bring you in, take you out, bring you in, take you out. That would be frustrating, but that's never, it's kind of a possibility. So it looks good. Apple just continues to confound all the skeptics, and I'm a skeptic. I just, the earnings and sales are just so uh, undynamic, if that's a word. Let's go to the weekly chart. You can see, like, I mean, when's the last time they've had anything of any kind of cancelamish nature? But yet there's the stock within inches of a new high. It is what it is. I would have not thought I would have guessed no, that I would have thought that this could be like a high for Apple for a long, long time. I might have even said that out loud. I'm probably going to be proven wrong. It just seems like it's going to take that out. In Google, I know they loved their AI day yesterday. Kind of a choppy cup with handle here. I probably an avoid to me. I think there's better stuff. Microsoft acting fine. Meta acting really well. And here's a basket, FNGU. Now this is the let's use FNGS actually, because that's not levered. So this is the basket of FANG stocks, and again, bullish or neutral. It does nothing looks bearish there to me on that. What else? I think those are all the big boys that I wanted to mention. So how about Lilly and NVO? So Lilly was tempting today. I thought about buying that today when the bounce off 50 day. Volume is starting to come in. It's acting better than NVO, a little bit better, not dramatically better, but better. Like NVO is below the 50 day. And look at the relative strength, man, and kind of a lower low here. Let's see what Lilly did. Eh, just a tiny bit better, but um, yeah, I don't know. NVO looks like just a watch for now. I mean, at that point right there, it was my biggest position. And then, by there and there, I had to unload it, unfortunately. I just can't. It shouldn't have done that. If it goes into new high, it's welcome to not keep going up, but I don't want it to give back those gains and then some. This is, at least the way I trade, right or wrong. That's the way I would do it. So NVO and Lilly are probably on a lot of people's brains. CRISPR had kind of a really wild day today. Look, it went from 40 to 76 in a hurry, and the news came out today on the approval. And so you have this really kind of crazy bar. I know a lot of people probably have this one. I saw a lot of talk on Twitter about it. It probably just needs to rest. Imagine you didn't have pattern rec. I always say, what would I see if there was no pattern rec? It's not ideal, but that looks like a cup with handle to me. So maybe we can get some sideways here. And if the market is really good, you get your second leg from something like this. Now, this is really speculative, but that's kind of what, maybe if there's animal spirits in the market and they're looking to speculate, a stock like this could go up a lot. It's had a great run before um, in these periods. And I know there's no earnings and sales, but like Bill would say you can't put a price on the cure for cancer, right? So I know if you've never heard this story, Justin was surprised by a stock that Bill had on his portfolio in the late 90s. I think it was DNA was the ticker at the time. And Bill was said, well, you can't put a price on a cure for cancer. So he loved the story and the chart. They didn't have earnings and sales. And if it doesn't work, I'm sure he just stopped himself out, which is fine. I think that's fine. I'll do that, and I will buy CRISPR if it sets up like that. How about MDB was a victim of earnings gap down. So, I've talked about this before. If you have it, you're in something like this, do something and hope you're wrong. So if you had 1,000 shares, just to make it easy for me, sell 300, sell 400, sell 500, sell 600, sell 200, sell something. If you can't bring yourself to sell it, just sell something, reduce your position. Let's say you had 1,000 shares and you sold 400 at 412 when it opened, or 410. Now at 380, that's a great sell. And what happens is you create a mindset at 410, that at 400 you're like, oh man, that was a good sell at 410. Maybe I should sell some more at 400. Maybe you sell another 100 at 400. Maybe you sell another 100, 200 at 390, and you get yourself out a little bit more elegantly than if you do nothing. My experience is nothing. I do nothing. I do nothing, and then I just can't take the pain anymore and just hit the bed and just puke it up. I've done that a million times. Just get me out. And so my average is 380, whereas if I'd done the other way, my average is 396 or something like that. So you just get a much better price. Let's say you sell 400 shares here at 400. I sell 400 at 410, Scott. The stock halts and Microsoft buys them out at 500 30 seconds later. So what? Congratulations. You still have 600 shares up 100 points. So focus on what you have, not what you don't have. Protect what you have, and that's how I would think about it. So if you can't bring yourself to sell, try 100 shares. Not going to hurt you. Just do something. So I don't know. It doesn't look broken or anything, but you look, the market's been pretty strong, and you've had three kind of lousy days, and Datadog too. So it gapped up, kept going, and it looks fine. It just looks like it's just kind of handling here, but it's frustrating when you're in them and the market's going up. That I know how that works. Lulu, what a great stock slash company. Opened down on earnings and couldn't stay down, rocketed up. So it's been a little tricky, like up and down and up and down. This is kind of stock you probably just want to own. And, and this is kind of why buy and hold works. Because if you find these, I know some people out there do it. They hold on to Tesla. The guy sent me a thing in Twitter on how long he's owned Microsoft for like 12 years. His cost basis is incredible. People do it. I'm not good at it. I'm trying to get better. I feel like I've gotten a little bit better. I'm not as good as some of these other people, but we all have strengths and weaknesses, and this is a weakness of mine. But they're out there for you if you can find them. I'm just no good at this part. It's just too hard to uh, to stomach that. So that's what I got to learn, to be willing to allow them to ebb and flow a little bit. But this is a great company, great stock, acting super well. I think that's it. I'm looking around for other stocks. Uh, the uranium, if anybody is interested, I'm still in the physical. I don't own this anymore. Nothing wrong with this, acting fine. It's kind of sitting here, and this looks very bullish to me, but it's not going up. And so I'm just not a fan of miners. Miners are tough. The guys digging the stuff out of the ground always seem to struggle versus the actual commodity. And this is about 20% roughly physical and 80% miners all over the world. And the physical is not listed on New York Stock Exchange. That's why it's not in Microsoft, in MarketSmith. Uh, that and then um this stock was very interesting today, MBI. It was a $7.50 stock, and they announced an $8 special dividend last night. So I can't recall that ever happening before. I'm sure it's happened, but I can't recall where they do a special dividend that encompasses the whole price of the stock. So very interesting. I bought it right away in the after hours yesterday just because I thought it reminded me of the Union the Union Pacific story in Reminiscences of a Stock Operator, which if you haven't read, you must read. And if you've read a long time ago, you must read again. But there's a great story when well, the the character's name is not Livermore, but it's loosely based on Jesse Livermore, where he's short Union Pacific. At first he was long it, then he got a tip to be short it, and he went short, and of course he regretted that. The next day the board declared a 10% dividend, which was very unusual at that time, and the stock gapped up like it's hard to know for sure based on history. It's a little different back then, and in the early aughts or 1906, 1905-ish area. But when William O'Neill and company, when they researched it, they sent out some charts of stocks from the Reminiscences book. It's just really cool. So it says he was short at 162 on a tip. The board declared a 10% dividend. He covered his short and went long at 172. So not only did he cover the short the next day, which must have been hard to do, a lot like MDB gapping down. This is gapping up against him. He actually went long, and the stock rallied to 180, and then the very next day it was like 190, and he sold. So he made up his loss. But that I don't know, that triggered in me when I heard this dividend. I thought that's an unusual special dividend, and it reminded me of this story from Reminiscences. And then when I pulled the chart, I was like, oh, well, the stock, it's just going to keep going up based on history. And then maybe the next day it'll go up again. So I just bought it. And then this morning I think it opened higher. Then it started to pull back a little bit. So you can see it opened around 12 and a half and then pulled back like 1190-ish or something. Um, and then, closed at or near the highs. But look, it's kind of a punt, a different type of trade, interesting, but something that I thought of based on, let's see if all these books I've read will pay off for me or something. So I would expect this to go up at least for a couple of days, and then let's see if I want to hold in anticipation of the dividend. Um, so, but that's very bullish action overall for the market. Like that's it for it to for them to offer that type of dividend, and then it's not what they say, but the stock's reaction. That's most important for me. I think I want the stock to confirm the news that you think that you're hearing. Um, so overall, I think the market's constructive. I don't think it's a spot where you want to run out and get really loaded up. You'd be subject to whipsaws for sure. But we're near the end of the year, and for me, I like to slow it down a little bit in December because I tend not to take too many breaks during the year. I tend to be active all year, so it's hard to do that. So I tend to slow down a little bit in this December, and I will be, at least for my taxable accounts, I'll be all in cash going into the new year because then it's just easier for me to know how much I made and what my taxable gain is because I never haven't had any long-term gains anyways. It's all short-term income. And so in for the non-taxable accounts, which I have mostly of those, it's different. I don't have to worry about that. But that's how I play it for the taxable ones. So we're getting close to that end of the year. Got what, another maybe another 15, 16 trading days or something like that. All right, let's go to the quote of the week. And I apologize. This video is probably really long, but I hadn't done one in the last couple of weeks. I see somebody just emailed and wondered why he's been missing the update from me. So um, uh, it's because I was gone for Thanksgiving, and then when Harold and Arnie do their end of month one, I don't do one unless something drastically happens in the market. And I apologize for for this one because like I said, I'm been under the weather all week, and it's kind of hemming and hawing whether to do this one, to be honest with you. But I really felt like I wanted to because I had so much. There's so much that happened. Okay, so Unknown Market Wizards, another great read. It's the Jack Schwager book. It's yellow. It just came out in paperback. So if you don't have that one, get the paperback. It's got like a little. There's not that much of a follow up. I was kind of a little disappointed, to be honest with you, but it's the original, and then he follows up with these traders with two or three or four pages, like what's happening now. So I actually have both books. I have the original now. I have the updated one in paperback. I was hoping that the follow up there'd be a little bit more meat on the bone, but that's okay. It's fine. I have plenty of friends. If they want, I'll give them the original. I'll keep one. But I would read that book. They're great reads. I think the thought process, the thinking, the way the way these guys and girls think about the market is what's most important. I really enjoy reading that. Um, so Richard Barg from Unknown Market Wizards. Trend following by itself is insufficient. The critical elements are how you manage risk and how you take profits once you are in a trade. I initially used to go for the home run when using trend following. However, I found that when there was a large up move and the market then came back down to my trailing stop, I hated giving back so much of my profits. You have to trade your personality. I like this because it applied to me. I just hate giving back open profits, unrealized profits. I know it's I know that those are still it's still my money. If I want, I can close that trade out, and so I just have a hard time psychologically giving back unrealized profits, and that's why I don't do very well holding for big moves. I'm I'm trying to get better at it, and maybe just take a little bite of the apple instead of um, you know devouring the apple all in one fell swoop. And that's how I've been doing it. So like the MDB trade in the opposite way, I do that a lot. If I have something that's working, I have 1,000 shares and I have that urge to sell it, I might just sell 200. I have to if I try to fight that urge, at some point in the market, there'll be a day or a time in the market where something will happen that will trigger me to get in protect mode, and then I'll sell the whole thing. So it's better just to sell 200 or 300 shares or 400 shares or whatever, and then let the rest run and hope that it's a bad sell. That's usually kind of how I look at it. So, but the key is, you have to trade your personality. Otherwise, you'll be disappointed. So I once wanted to be like Bill O'Neill, and I found out it just that I can't be Bill O'Neill. I got to be myself. I got to try to be the best version of myself as a trader. And there are some things that I do really well, and there are some things, honestly, that I do very poorly. I'm just not good at. And there's two schools of thought to that, which is very important. So, like, pretend I'm a football team, and I coach my son's flag football team. So you have offense and you have defense, and you have no choice. You have to play offense, you have to play defense. And so you got to be good at both. You got to build up your weaknesses and try to get better at those. You can't just leave them be. But in the market, I can find areas where I'm weak, and it's likely, more than likely, that I can just ignore that. So if I'm weak at options, then I can just not trade options. If I'm weak at ETFs, I can just not trade ETFs. If if I find myself weak at on earnings releases, on handling earnings, like I'm not handling them correctly, well, then I could avoid earnings, which is kind of why I've developed my strategy slowly but surely through the years of just holding through earnings regardless, because I was cherry picking them and I had a high degree of cherry picking wrong. I would hold the ones that would go down and I would sell the ones that would go up. And that was frustrating to me. It's like, how did the market know that I held XYZ and sold ABC? So now I keep both of them. I will and very often adjust the position because I know it's going to be potentially highly volatile event. But I'm gonna, if I like the stock, it hasn't hit my stop, I'm gonna keep at least some of it for sure. So that's kind of how I do it. So and I've talked about this till I'm blue in the face. You guys have heard it a million times, but figure out what you're good at, trade your personality. Um, you'll be better off for it. All right. Thank you guys. Have a great week. Probably back next week. Marcus Smith at investors.com, 800-424-9033. Take care, everybody. Bye bye.